Is wheat futures trading too complex for beginners? Imagine trying to predict the weather months in advance or guessing how much wheat will cost next year. That's what trading wheat futures can feel like at first. Wheat futures are contracts to buy or sell a set amount of wheat at a specific price on a future date. Each contract usually covers 5,000 bushels of wheat. That's a lot of wheat, and it's traded on exchanges like the Chicago Board of Trade. These contracts are standardized, which means they follow strict rules about size and delivery. One reason why wheat futures seem complicated is because of leverage. When you trade futures, you don't need to pay the full price of the wheat. Instead, you put down a margin, which is a small percentage of the total value. For example, if the margin is 20% and the contract is worth $50,000, you only need to deposit $10,000. But this also means your gains or losses are magnified. If the price moves just a little, you could make or lose a lot. Another tricky part is understanding when contracts expire. Wheat futures usually have set expiry months like March, May, July, September, and December. Before the expiry date, traders must close or roll over their positions. If they don't, they might be forced to take physical delivery of wheat, which is not practical for most retail traders. Knowing these dates and managing your positions accordingly is essential. Wheat prices are affected by many factors. Whether conditions like droughts or floods can reduce supply. Global demand from countries like China or India can push prices higher. Political issues or trade policies can also influence the market. Successful traders often look at reports from the United States Department of Agriculture and weather forecasts. They combine this with technical analysis, which involves studying price charts and trends. Price swings in wheat can be sharp and sudden. Unexpected weather or geopolitical events can cause prices to jump or fall quickly. Beginners need to learn how to protect themselves from big losses. Using tools like stop-loss orders can help limit potential damage. Wheat comes in different types, such as hard red winter, soft red winter, and spring wheat. Each type has its own uses and market dynamics. Futures contracts may be specific to these types, adding more details to understand. Despite these challenges, trading wheat futures can be rewarding. It offers a way to hedge against price changes or to speculate on market movements. Beginners should start small, learn the basics of futures trading, and consider alternative ways to participate. For example, trading contracts for difference allows you to speculate without owning the physical wheat or dealing with contract expiry. In the end, wheat futures trading is not impossible for beginners. It requires learning about contracts, managing risk, and understanding market factors. With patience and education, anyone can develop the skills needed to participate in this major agricultural commodity sector.